In this video, I want to talk about things that I've learned over the years from Wall Street's best, some of the best traders on Wall Street, some working at prop firms, some being independent traders, and some being responsible for managing, billions of dollars. These are things that really stuck with me throughout the year. I still put these things into the test on a daily basis, and I recommend everyone watching this to do the same, and it will help your trading tremendously by following the footsteps of what large traders on Wall Street do themselves. We can replicate and put it to the test in our own trading. Before we get into the things that I learned, I'm going to post a link in the description below to follow me on Instagram at Entretrade. I definitely recommend doing so. I post daily trading recaps on there, along with very good trading tips and tricks that I guarantee you're not going to find anywhere else. The link will be in the description below. You're seriously missing out if you're not following it. But now, the first quote that really stuck with me is Bruce Kovner. And he says, position size, he traded much too big. For every one contract I traded, he traded 10. He would double his money on 2 different occasions each year, but end the year flat. Now, what this tells me, and I see it on a daily basis with a lot of retail traders, is they go into the market with an ego through the roof and they size up on their account. I don't care if you have 100,000 in your account. I don't care if you have $1 million in your account. When you are first starting off trading and you are failing to be consistent, or you're just not profitable yet, but you feel really close, the worst thing you can do is size up. Believe me, it's natural for us to want to make more money and size up, but this is a process. It's something I always stress, and everybody sizes up way too large. And what this does is it makes them trade off of emotions. When our emotions get attached to the chart, we make decisions, not rational ones based off of what the market's telling us, but we make decisions based off what we're telling ourselves. And that is not good to trade, because sometimes the market's going to present, true factual information, but we can't perceive this information. We can't comprehend it because our thoughts and our mind is trying to tell us something different. This is what happens when we size up and we get too big. Yeah, you might make money, a lot of money off of 1 trade or 2 trades, but personally, I know some traders, let me know if you relate to this, that made a lot of money on GameStop and AMC when everything was going crazy. They made a lot of money. They sized up. It worked out for them. And the same people that made a lot of money back then, I can guarantee you lost more than half of it, or maybe even all of it, because they're still trading too large of a size and they think the market's easy, that their large size is going to equate to more money. Their emotions get attached and they struggle to be consistent as a trader. What we can do is reduce our size and watch how much better you will trade. It's a major key, and everybody I tell this to has more success, and they follow the process, and then they could scale it up from there. Reduce your size, watch how much better you trade. I post this in my Discord all the time, and this is very key advice. If you are new or have been trading for a while, yet you're failing to be consistent, here's what you have to do. Trade with small size. I don't care if you have 100,000 in your account. You should only be trading 1 to 3 contracts regardless of account size. Too many people think it's easy, they know what they're doing, and they blow up a large account without having an edge. You're basically gambling, and you're just giving your money away to the market. Later in this video, I talk about capital preservation and playing defense. This is the way we could play defense. Reduce our size when we do not have an edge and we do not have a system that we are consistent with. In this period of small size, you learn via trial and error. You develop your system, you learn from your wins and losses without hurting your account and without losing a lot of money. You must lose in order to win. There's no way around it, and I attribute a lot of my success to learning from my losing trades, having pain in the market, and figuring out what not to do and what to do a lot of, which worked out for me the best. This is the only shortcut, and this is how you become a better trader. Once we develop this edge and we build the system, then we could scale up. And for, like I said earlier, from some guy trading 2 contracts, some guy trading 10 contracts, the process is the same. If you see somebody make $10,000 on a trade versus someone make $50,000 on a trade, all that's different is the position size you click before you enter the trade. If you follow the same process with 1 contract, with 10 contracts, with 100 contracts, you're doing the same exact thing. The only difference is you're adding another 0 to your position size, which in result is going to make you more money. So scale down until you're consistent with small size, and then you could scale up. Trading is the most scalable business, meaning 1 contract, 10 contracts, 100 contracts is the same exact process, and you're following the same exact thing. Build up. Everybody tries to go from 0 to 100 in this game, and it just results in failure. The faster you come into the market, the quicker you're going to leave it. The market's not going anywhere. The next quote is from Paul Tudor Jones. The most important rule of trading is to play great defense, not great offense. Every day I assume every position I have is wrong. I know where my stop risk points are going to be. I do that so I can define my maximum possible drawdown. Hopefully I spend the rest of the day enjoying positions that are going in my direction, and if they're going against me, then I have a game plan for getting out. I stress this all the time for Investor-Trade members to play defense over offense. You might hear people in the NFL, NBA saying defense wins championships. It is the same exact thing with trading. Defense will make you money versus playing offense. It's more important to preserve your capital than it is to grow it, because when you preserve your capital and you play defense, offense and the growth is going to take care of itself. It's very important to not swing for home runs. Everybody's on offense trying to swing for a home run. The more times you swing, the more times you're going to strike out, especially if you're a beginner and failing to become consistent. Now, on top of this, if you don't play defense, you don't know where your stop loss is going to be, you don't know your target, and you don't have a plan, then basically you're swinging and you're going to swing, strike out, and you're going to be out of the game because you got no more money left. Before every single trade, before you click that buy button on the computer or on the phone, you must have a target in mind and you must have a stop loss in mind. For me personally, I go into every trade expecting it to be wrong and expecting to lose money. Because if we could prepare for the worst, if it's better than the worst thing that we prepared for, which we never let it get worse than worse, but if we prepare for the worst and it happens, something happens, the result happens that is better than the worst, then it's a win. So play defense. Always know where you're going to be wrong and how much you're going to lose. That's very key. And we kind of can relate this to the first point, where when you trade with too much money, you don't know how much you're going to lose. And you might trade with your full account size, and one trade destroys 50, 60% of your portfolio, and you got no more money left to hit the next setup. And you don't realize the next setup is going to be your best trade you've ever taken. So always know the maximum drawdown, how much you're risking, and how much you're going to win if you're right. Prepare for the worst, because there's a lot more things you could do if something happens better than the worst thing that you planned for. Then it's stress-free. If the market's moving in our direction, we could hold on to our target hits. It should be stress-free with less emotions attached. So from the pre-market plan that I do post in my Discord as well, we were watching the S&P 500 and we were watching the 4099 demand zone, and be very cautious around the 4127 and 4151 supply zone. So the idea here is to play long at demand. And when we came into this demand zone, I did not find proper confirmation to get the market long. So this is me playing defense, because as the market was coming up, I did not feel comfortable. If I did not get an entry somewhere in this area close to demand, I did not feel comfortable that by the time I got valid confirmation to enter all the way up here, because now my risk to reward is skewed. It's all about playing defense and not offense, maximizing your reward and minimizing your risk. In this point, my risk is way too high for my reward. I played defense and I waited for another setup. I preserved my capital, because if we preserve the capital, it's going to grow. If I chased this move and I was playing offense, swinging for a home run, and let's just say I got long all the way up here, I would have got dumped on, and I probably would have stopped out of this trade if I implemented poor risk management. However, we could look at it on the other hand now. Let's just act like I did get long at this demand zone. I have an entry right here. My stop loss is the lower oval. So risking about 10 points to make about 30 points. Pretty good risk to reward. As the market's coming up, let's just say we pull back down. My stop loss is at the low. If I implemented proper risk management and followed my plan, this pullback would not have stopped me out, even though I'm playing defense, I'm still on the opposition because the market pulled back, my stop loss never triggered, and I still had a reason to be in this trade, and we could have capitalized on another little 20-point rally from that move up. So ones that are following our plan and the market's moving in our direction without our stop loss triggering, we can sit back and relax and let the trade play out without letting our emotions get involved. Now, this is going to bring me to my next point, which he says, don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you're very good. The second you do, you're dead. My biggest hits has always come to after I've had a great period and I start to think that I knew something. Going back to the GameStop and AMC guys that made a lot of money very fast, they thought, okay, I just made $100,000 on this one trade in one day. I'm a great trader. I'm going to do this again tomorrow. And instead of making $100,000, I'm going to make $500,000. It's possible, right? But now our ego is elevated. If I take a great trade, let's just say, and a lot of people take really good trades, they make a lot of money maybe for one specific setup, and they can't repeat that for the next one. Why they can't? Because their win from the first trade is making them think they're the best trader, and that's when our emotions get involved and attach to the trade. And the next setup we take, we struggle with because we want to make more money, we want to hit another home run, and our ego is doing the trading. You have to be as egoless as possible when you're trading. And one of the worst things you could do when you're beginning and you're just starting out trading is make a lot of money in a short amount of time, because I guarantee you're not going to be able to sustain and build longevity if you cannot repeat that process on a daily basis and have large wins on a daily basis, because you're going to always want more. It's natural for us humans to try to exponentially grow and scale up our account after making a lot of money. So it's very important. If you take a really good trade, do not get cocky. Do not think you're the best trader. If you can do that consistently, day after day, week after week, year after year, then yeah, you're a beast trader. You're awesome. You're going to make a lot of money consistently. But if you're having just, home runs one time at bat, and then the next 5 times you're striking out or just getting a base hit, you're not going to be sustainable in your trading. And after a large win, be very careful, because your ego is going to try to take over, and it's very easy for you to lose it all. The next quote from Tom Basso: I would tell the trader to think of each trade as one of the next 1,000 ones he's going to make. If you start thinking in terms of the next 1,000 trades, all of a sudden you've made any single trade seem very inconsequential. Who cares if a particular trade is a winner or a loser? It's just another trade. I want everybody, the next trade you take, before you take it or while you're in the trade and after you take it, think about the next setup. If I'm taking a trade right now, what's my opportunity cost for a trade that I'm going to take in the future? Is this trade going to put me out of the game, that I don't have enough money for my next setup, that the next setup could be a really good one and outweigh the loss from the first one? Always think that the next trade or the next 2 trades, next 3 trades, have those in mind. Is the trade I'm looking to put on right now a high quality one? If it's not, do not take the trade, or at least just reduce your size. With this in mind, think about the next setup, being patient, and wait for a high quality setup. On top of this, Linda Bradford Rasky said, it never bothered me to lose because I always knew that I would make it right back. I always knew that no matter what happened, I could go back into any marketplace with any amount of money and make a living. That's very key, because the best traders are not afraid to lose if they have an edge and they have a system that gives them a positive expectancy over the long run, where they could repeat the process day after day, week after week, month after month. I said in one of my past videos, back on Wall Street, when I sat with a very talented trader, he lost $800,000 in a single day. It's the most amount of money that I've seen somebody in person ever lose, right? I didn't even know he lost the money until after, when we got beers outside of his office, he told me how much he lost that day. I would have never known he lost that amount of money. That's, a lot of money to lose. But in relation to how much he's winning, $800,000 is nothing. The point I'm trying to make here is he didn't even let an $800,000 loss affect his mood, to the point that I couldn't even tell he lost money that day. So it never bothers the best traders to lose. I don't care if I lose. I'm transparent about all my winners, all my losers, because there's a lesson to be learned on every single one of them. If you have a system that works out for you, you don't care about losing because you know the next trade you're going to take might be a winner, or the one after that's going to be a winner, or the one after that's going to be a winner. So that's what I mean by looking at the next 100 trades or 1,000 trades you're going to take. Those could be winners, some are going to be losers, but always think about the next trade. And if I'm entering right now, what the next trade is going to be like. There was a setup that I took on the S&P 500 where one day I took the same exact setup. It was like a Tuesday or Wednesday. I took a setup. It resulted in a loss. The next day, I took the same exact setup at the same exact price, and it worked out. And that one winner outweighed that one loser from the day prior with the same exact setup. No matter what happens, I could go into the market with a positive expectancy. I brush off losses because I know my system's going to work out for me more often than not. That's when you have the confidence to be okay and acceptance of losers. It sucks to lose. Everybody wants to win. It's human nature. But you have to be able to accept losses in order to win in trading. If you can't and you get upset, you punch your screen, you're freaking out, you punch your pillow, you start freaking out about losses, you are never going to be successful. Everybody has losses. If somebody on here, YouTube, Twitter, Instagram, whatever, does not flaunt losses, they are fake, irrelevant traders because everybody has them, even Wall Street's finest. They're inevitable. You cannot avoid them. A perfect example of this was a little while back in July. On the S&P 500 in the pre-market plan, we were watching for us to get above 3949 and 3968 supply, which is this pink box up here. If we could do so, we were going to rally, and we were probably going to go test the 4010 supply zone above, acting like a magnet. So what happened was the market opened up, and we rallied straight through the supply zone. I waited for consolidation, and I liked the structure in the market that we saw here, and I played the market long with a stop loss below 3963. I actually made a video on this back in July 22nd, I think, or 23rd. So now I'm in long, anticipating a breakout right here, targeting the next supply zone above. My stop loss is here. A few minutes later, we dump, and I stop out of this trade for a losing one. It happens. We all have losing trades. We can't avoid them. It's a part of the system. Instead of putting my head down and saying, oh, I'm a terrible trader, I don't know what I'm doing, I suck, I have confidence in my system. I trust myself, I trust my edge, and I trust how I trade because this is what I do that makes me profitable week after week, month after month. It's what makes me money in the stock market. And then the following day, keep in mind, the day prior, I got long around 3970, 3967. Then the following day, in the pre-market plan, same exact thing. We are watching for the market to get above the same exact level, targeting longs. I'm open to playing longs, targeting 4,000 and then 4,010. So I was basically looking to get long above 3972-ish, targeting the supply zone above. The same setup from the day prior that I took a loss on. Guess what happens? The market broke above 3970. And as soon as we got above this 3972 area, I took the market long, stop loss below 3965. Same exact trade I took the day prior that I lost on, same exact entry, same exact stop loss, same exact plan. Identical price action. Instead, this trade worked out and I sold at the 4,000 mark going into end of day. So the plan worked on Wednesday or Thursday and the plan didn't work on Tuesday. It's repeating your process day after day, trusting it, being okay with losing because you have confidence in your edge that it's going to give you a positive expectancy over the long run. You could have a 50% win rate or a 60% win rate and be a profitable trader and make 6 figures, 7 figures a year. It's very possible. You don't have to have a high win rate like 90% or 95%, even 80%. Those are high win rates. Don't need that to be profitable and to make money. Al Weiss said, the essential element is that the market is ultimately based on human psychology. And by charting the markets, you're merely converting human psychology into graphic representations. I believe that the human mind is more powerful than any computer in analyzing the implications of these price graphs. It's very key. This is why I think humans are smarter than algos, because humans can recognize and adapt to market context, which algos that are written on mathematics cannot correlate the human nature or the context or the emotions behind the charts. It's a serious edge in itself. I've said it in one of my other videos, to understand where everybody else is buying or everybody else is selling, where other traders' stop losses are, where their take profits are. With this information, we could do reverse psychology, and it gives us an edge. When everybody's buying, look at ways to be bearish. When everybody's selling, look at ways to be bullish. The market is represented in psychology. The charts basically just show human emotion. Somebody's buying down here, they perceive it to go up in value at some point in the future. If somebody's selling up here, they perceive it to go down in value at some point in the future. The markets and the graphs just represent human psychology and human emotions. Traders facilitating trade with the auction about buying and selling. If you can convert human psychology and understand where a lot of traders are perceiving value, fair value, unfair value, and just understanding where traders are interested in trading at, that gives you an edge. And that's a serious little cheat code with the market that you could take really high quality trades and gain from other people's impatience and other people's miseducation or being uneducated about when to enter and exit in the market. What I mean about reverse psychology, this works in any market, any instrument, it doesn't matter. It's how the market moves. For example, here's in a trade on Apple. We had a very strong rally the day prior. We put in a resistance high over here, and the following day we broke above it and failed. Now, from an intraday basis, the market's downtrending. We have some selling pressure over here, and we're putting in lower lows and lower highs. In fact, we not only reject VWAP, but we also break the low on Apple. Now, when we break a low or we break a high, everybody's looking to get long or short something. If we break a high, everybody's looking to get long. We break a low, everybody's looking to get short. Reverse psychology this. If everybody's getting short below a level, and let's just say we have demand down here, it's a perfect recipe for a market reversal, entering off of the fact that not only do we have demand, but we also have an area that a lot of traders are getting short a name. When everybody's short and the market's not working with them, with their short, what are they going to have to do? They're going to have to cover. They're going to have to buy back their shares, and that buyback is a buy in the market, and that's just going to fuel another move up, especially when we're inside a demand zone and some orders get filled, then the market moves up, and we had a clean reversal off of Apple just by understanding market psychology, where a lot of traders are looking to get in and where a lot of traders are looking to get out if they are wrong. Very key, and it helps us give an edge with the market. So I'm going to leave you all off on that note. I hope this video helped. I can do another video if you guys want about traders that I know personally on Wall Street that I've met face to face and go over some things that they told me. If you guys want that, I would appreciate a like on this video. Comment if you have any questions, and definitely check out the links in the description below. But I'm ending it. Peace out.